Leverage is central to loan covenants because it directly influences a borrower's risk profile and triggers a cascade of legal obligations and restrictions when thresholds are breached. High debt levels increase the likelihood of covenant violations, which can lead to severe contractual and operational consequences for borrowers. Leverage matters in loan covenants because a borrower's debt level is a primary indicator of financial risk. Loan covenants use leverage metrics like debt-to-equity or debt-to-EBITDA ratios to set boundaries on how much debt a borrower can take on. If these boundaries are crossed, it triggers legal obligations and restrictions, such as higher interest rates, forced repayments, blocked access to further credit, and even acceleration of the entire loan. These mechanisms protect lenders by providing early warning signals and legal remedies, while also incentivizing borrowers to maintain prudent financial practices. Fundamentals. What are loan covenants and why are they used? Loan covenants are contractual clauses in loan agreements that require borrowers to maintain certain financial standards or restrict specific actions. They come in three main types. Affirmative covenants require actions, e.g., providing financial statements. Negative covenants prohibit actions, e.g., taking on more debt. Financial covenants set quantitative thresholds, often based on leverage ratios. Purpose. Covenants are risk management tools for lenders, ensuring ongoing financial discipline and providing early warning of credit deterioration. The stringency of covenants is tailored to the borrower's risk profile. Higher-risk borrowers face tighter leverage limits. Leverage metrics, measuring debt in covenants. Leverage ratios are key in financial covenants, helping lenders assess risk and ensure borrowers can manage debt. Common metrics include debt-to-equity ratio, limits overall leverage, 1.5x, 3.0x typical thresholds. Debt-to-EBITDA ratio, evaluates debt serviceability using cash flow, 4.0x, 5.5x in LBOs. Interest coverage ratio, ensures earnings cover interest payments, 2.0x, 4.0x. Debt service coverage ratio, confirms ability to meet all debt obligations, 1.2x, 1.5x. Thresholds vary by industry and borrower risk, with tighter limits for riskier borrowers or volatile sectors. These metrics promote financial discipline and provide early warnings of credit issues. Leverage metrics, measuring debt in covenants. Leverage ratios are key in financial covenants, helping lenders assess risk and ensure borrowers can manage debt. Common metrics include debt-to-equity ratio, limits overall leverage, 1.5x, 3.0x typical thresholds. Debt-to-EBITDA ratio, evaluates debt serviceability using cash flow, 4.0x, 5.5x in LBOs. Interest coverage ratio, ensures earnings cover interest payments, 2.0x, 4.0x. Debt service coverage ratio, confirms ability to meet all debt obligations, 1.2x, 1.5x. Thresholds vary by industry and borrower risk, with tighter limits for riskier borrowers or volatile sectors. These metrics promote financial discipline and provide early warnings of credit issues. When a borrower breaches leverage covenants, it triggers a technical default, even if payments are current. Lenders gain legal rights, including demanding immediate repayment acceleration, imposing penalty interest rates, requiring additional collateral, or suspending further credit. Defaults can also activate cross-default provisions, forcing repayment of other loans. Borrowers may face operational restrictions, mandatory prepayments, or enhanced reporting requirements. If unresolved, breaches can lead to insolvency or asset liquidation. Legal frameworks like the UCC support these enforcement mechanisms.